Good afternoon and welcome. My name is Jim Otteson. I'm the John T. Ryan Jr. Professor of Business Ethics in the Mendoza College of Business at the University of Notre Dame. I'm also the Rex and Alice A. Martin Faculty Director of the Notre Dame Deloitte Center for Ethical Leadership. And on behalf of the Deloitte Center, it's a pleasure to welcome you all to this discussion of Doing Well and Doing Good. A scholar and practitioner discuss ESG. So we're privileged to welcome two distinguished guests to discuss ESG, or environment, social, and governance measures for evaluating the sustainability and social impact of corporations. Our first guest joining us from Berkeley, California is Amelia Miazad. Professor Miazad is a lecturer in the UC Berkeley School of Law, where she also received her law degree in 2002. She's an expert in sustainable capitalism and is founder and director of the Business in Society Institute at Berkeley Law, whose mission is to define and advance a legal and policy agenda that encourages companies to take account of stakeholders and the environment. Amelia teaches several courses at the intersection of stakeholder capitalism and corporate governance, and she's designed and teaches several executive education courses for C-suite executives and board members around the world. Her many recent publications explore things like stakeholder governance and ESG, as a process for overseeing risk and a powerful tool for transforming corporate culture. Both Amelia's curriculum and her scholarship rely heavily on input from experts who are implementing environmental and social considerations into their business and investment practices, and she regularly presents to audiences of corporate executives in the United States, in South America, and in Europe. Joining us from London is our second guest, Bill Kennedy. Bill is a portfolio manager at Fidelity Investments, where he's been employed since 1994. He currently manages the International Discovery Fund since 2004, and he co-manages the Worldwide Fund since 2006. In 2020, he launched an International Environmental, Social, and Governance Fund, which is in its pilot stage now. And his assets under management total about $12.5 billion. Bill is based in London, where he's lived for the last 14 years. Previously, he managed several of Fidelity's Asia Pacific funds and was based in Tokyo. He also lived in Hong Kong, where he was an analyst for Fidelity, covering emerging markets, and was director of research, where he led Asia's largest buy-side research team. Bill also has significant Notre Dame connections. He's an adjunct assistant teaching professor at Notre Dame, where he teaches a class called Investing in Emerging Markets. He graduated from the University of Notre Dame in 1990. In fact, he and I were classmates. He had a degree in economics. He also chairs Notre Dame College of Arts and Letters Advisory Council and is a director of Notre Dame in England. And he runs his own impact investment fund, as he says, in his spare time. So Amelia and Bill will each make some opening remarks, and then we'll open the floor to questions and discussion. And so I will now turn the floor over to Amelia Miazad. Professor Miazad, the floor is yours.
Thank you so much. And thank you for this opportunity. This is going to be fast and this is going to be really fun. So let's get started. So I'm going to start with a 15-minute sort of crash course to orient us to what ESG is, its relationship to corporate purpose, and its relationship to stakeholder governance. So let's get started. You know, I'd very much, and I think we all would very much like ESG and the journey to look like this, but we all know that often it looks much more like this. But stay with me. We're going to go over 3 points. Point 1, what is ESG? Point 2, why today? And I'm really excited to discuss and debate the why today question with Bill, who understands it very well. And what is the relationship between ESG and stakeholder governance? Because these things are often used interchangeably and conflated. So the glaciers are melting. We have 15 minutes to get through this, and we need to go quickly. So defining ESG. Now, it of course, as James said, stands for environmental, social, and governance. Okay, but it covers such an expansive area of topics, from diversity and inclusion to plastic straws. Now, what on earth do these two things have in common? Of course, these two things both suck, right? The lack of diversity and plastic straws. But other than that, it is really hard to see why these two things would be under the same umbrella. So the point there is that ESG is very broad. And at the end, I'll explain why the breadth of ESG, which is viewed as its weakness, is in fact its strength for corporate managers and for investors. The other thing is ESG, stakeholder governance, all of these terms are used interchangeably. So here are some terms in this sphere, in this ecosystem. And I'm sure that you've heard so many of them. And there's a new one, it's EESG, which the former Chief Justice of the Delaware Supreme Court, Leo Strine, coined, with the first E representing employees, feeling that the S wasn't sufficient enough. So there are a lot of different terms. And sometimes it can feel like ESG is a black hole. The way that I define ESG is that as governance. It's a governance system for overseeing environmental and social risks. And the way I came to that definition or that understanding is by talking to people like Bill. Investors, increasingly boards and C-suite executives view ESG or leverage ESG as a way to govern environmental and social risks. And today it's all about risks. ESG is a way to identify red flags. What kinds of risks are we talking about? So we're talking about risks that are specific to each individual company, but also increasingly, experts like Bill look at systemic risk or systematic risk, which affects entire portfolios and our entire economy. So an example of an individual company risk might be your company's carbon footprint, but that materializes into a systemic risk for the planet, climate change, and a systematic risk in Bill's portfolio, climate change. And so these things are all interrelated, and increasingly that ESG is helping investors navigate systematic risk to their portfolios. So at the present moment, it's hard to understand the present moment without going a bit into the past and understanding the past. So in the past, there was CSR, and some companies still use CSR or corporate social responsibility to refer to ESG, but I distinguish the two. CSR really had its origins in doing good, solely for the purpose of doing good. So I like this slide one, I'm coming to you from Berkeley, I've got to show you a hippie or I get fired. But it was not about making money in the early days, okay? It originated in corporate philanthropy, and sometimes those who are not evolved, companies who don't think about ESG in a more evolved way, aren't farther along on their ESG journey, still confuse it with corporate philanthropy. There was limited C-suite or executive oversight. It was a very siloed function, sometimes in public affairs, sometimes in the human rights group. And companies essentially did good to negate the bad that they did. So you might have a company that, polluted the environment and built a school. There's no integration of building of the school into their business strategy, but it was pure philanthropy. ESG is very, very different. It's linked to long-term value creation. There's broad investor support and growing investor support. And it's really embedded in business strategy. So the company thinks, what do we do well? And how can we leverage that to address social and environmental risks? It's increasingly cross-functional, both in the C-suite and at the board. And it's about doing well by doing good, okay? So these folks, these are the C-suite executives, the compliance officers, the general counsel, the CEOs, they are interested much more in ESG because it is a powerful tool for mitigating risk. And we see headlines like this every day. There's no hotter area on Wall Street than ESG today, right? Which is why we're having discussions like this more and more, to my delight. So Let's go to point number 2, which is why is the focus on ESG growing today? And we'll build upon this in our discussion with Bill. But there's essentially a perfect storm. We could do an entire semester class, and I do an entire semester class on why, just solely the why now question. But here are some of the reasons that we go through in that semester all on one slide. There are theoretical reasons. There are reasons that are very much grassroots. There are reasons that are systemic, like weak governments placing more pressure on companies or unsustainable environmental externalities. And let's look at just a couple of these reasons, starting with, I'm a law professor, so starting with theory, of course. Now, we all know Milton Friedman said the only social responsibility of business is to increase profits. Now, I do want to pause for a moment to point out that Milton Friedman has been very unfairly attacked for being just solely focused on shareholder profits alone. So he's become somewhat of a caricature. And if you really read his writings, there is a lot of nuance and there is a lot of validity to having a clear focus also on shareholders. So, but let's just continue with the caricature of Milton Friedman. So Milton Friedman's view was that we should maximize shareholder value, that shareholders are the owners. It's good for society to do this. Directors are agents. And this is a very clear articulation of what everybody's duties and responsibilities are. Now, there were scholars who were arguing, a different view. Edward Freeman, he just published a book called The Power of And, argued for stakeholder theory. He was one of the first, some would say, coined stakeholder theory. But stakeholder theory in the 90s did not gain that much traction. It has not gained a lot of traction until this very moment today. Okay. Indeed, in the 2000, there was a famous paper published, The End of History for Corporate Law, in which scholars argued there's no competitor to the view that corporate law should strive to increase shareholder value. Now we just need to figure out how to implement that. We don't need to debate this anymore, nor will we. Of course, they were wrong because we're debating it right now. This debate is one of the most prevalent debates in corporate law today. This is a fantastic debate with Professor Colin Mayer from Oxford, arguing for stakeholder capitalism and a stakeholder-oriented view of corporate purpose, and Professor Lucian Bebchuk from Harvard arguing very persuasively, both of them, that shareholder primacy serves a purpose because it manages the expectation of all the stakeholders, and in the end, stakeholders do better because of that clarity. So I encourage you to take a look at this debate. It's on YouTube. But regardless of the debate that's happening in academia and the validity of that debate, the business community, as Bill will tell you, has moved on, has embraced stakeholder theory. Who famously said this a few years ago, which made headlines? It was Larry Fink, the CEO of the largest asset manager in the world, saying, let's look at it again, your company must serve a social purpose. And now we don't even hear this anymore because it's become so commonplace for the largest players in the investment community to make statements like this. Including the titans of Wall Street, the 4 largest asset managers. And it's influencing business. So you see businesses, immediately after Larry Fink made a statement like this, disclosing in their financial statements that their obligations are to stakeholders. So it's not just puffery or statements in interviews. It's actually in their financial statements. Some companies are making these disclosures. We of course know about the Business Roundtable statement of corporate purpose, but the important thing is that this phenomenon is very much international. We saw with the Davos Manifesto that the international business community has also embraced a stakeholder-oriented view of corporate purpose. So COVID-19 happened, of course, last year. It came to us somewhat, while many predicted it, somewhat unexpectedly for the business and investment community. And a lot of people in my circle, I'm sure in Bill's circle, were saying, oh, this stakeholder governance stuff is over. This social purpose is over. Wall Street is going to double down on shareholder primacy. It's been fun for the past few years. In fact, exactly the opposite happened. We saw an increased emphasis on ESG and demands by investors for companies to serve a social purpose. We saw reports coming out showing that sustainable investing makes companies more resilient. There are several industry reports, there are several academic reports now showing that ESG factors are actually even more important during a downturn. They really identify what companies are managing risks well. So the third point on our quick journey today is why? Why is this happening? So if you read BlackRock's report, Resilience Amid Uncertainty, BlackRock concludes it's about building trust between stakeholders. And I did a paper as well and found the same thing, that stakeholder governance is a process for managing risks. So let's look at, what does social purpose mean in practice? Well, it means two things. The red is the risk. I'm a law professor, so I tend to focus on risk, but I know this is a business school. So let's talk about the opportunities too. Opportunity and risk are two sides of the same coin, of course. And so companies are being asked to manage their own environmental risks, but also address systemic risks. And in doing so, they can seize business opportunities. So what is the secret sauce? Why is ESG a process for this? I answered this question by digging into the ESG process and finding out, what do companies do when they have a very sophisticated, robust ESG or sustainability function? Well, it's a very new, integrated and a very detailed approach. And here are just the general steps, these 5 steps. But what these 5 steps do is they force companies to dialogue with stakeholders who they normally wouldn't be obtaining information from, including local communities, suppliers, employees, management. And because of the reporting and disclosure mechanism, this communication happens every day, year round. It's very iterative, and it gives management and the board an informational advantage that they lacked in the shareholder primacy model. And so it continues to just turn information and to give the board better and better information. And it breaks down corporate silos. Now, another thing that I just wanted to note is, because of this ability to garner information from employees and from local communities, companies are also, and because governments are weaker than they used to be, companies are also engaging in much more brand activism than they did today. That is one way that companies are addressing systematic or systemic risks that impact society. And we've seen this, of course, in Georgia with the business of business becoming politics. This is a very interesting area. It's a very tricky area to navigate. There are risks on all sides of this, but this is one way in which companies are serving their social purpose. And with that, I will turn it over to Bill to get his insights. But if you're interested in these materials or in continuing the discussion and debate, please stay in touch.
Thank you very much, Amelia. And I would say to the audience, the people who are listening, if you have questions you would like to pose, please use the question and answer function, which is in the lower menu bar of your screen. Rep Beasley will be monitoring those, and we will as well. So time permitting, we would be happy to have those questions. And with that, we'll turn it over to Bill Kennedy. Bill, the floor is yours.
Okay. Thank you very much. And thank you, Amelia. That was a great rundown on ESG. And, clearly it's a topic that is really is in front of corporate, not only corporate America, but companies all over the world. And I have the luxury of living in Europe, so we've been facing this for quite a long period of time. And, the one thing that, it seems like ESG has now moved from an area where people are, the market and in general, the public are looking at to avoid companies that are doing bad things, but the market is starting to reward companies that are doing good things. And that is very, very powerful because that kind of creates this reinforcement behavior where companies admire the company, or investors and stakeholders admire companies that are doing good, and you'll tend to find that companies will follow them that perhaps aren't doing so well. So I'm of the belief that not only is ESG good for humanity, it also is good for businesses, and it helps businesses improve themselves and gives them better returns to shareholders. Now, my journey in ESG is somewhat, I've gone back a long time with ESG, and it's really rooted in my work experience, and it's rooted in academia as well. I've been at Fidelity for over 27 years. And before that, I was in private equity, spent a lot of time visiting companies all over the world. And it was quite clear traveling and visiting companies in, as remote places at the foothills of the Himalayas, to, some of the most sophisticated companies at the foothills of Mount Fuji, where you can see robots actually making other robots. It's pretty scary. But, you find that there's a big differentiation in the types of companies that are out there. And the one thing that I did find is the companies that were doing the right things tended to do well in the eyes of investors and tended to have certain characteristics that investors liked. Also, some of my ESG is rooted in academia. I was a student of I studied a lot of humanities when I was at Notre Dame. I was in the College of Arts and Letters, and we read a lot of philosophy and theology. And I know, Jim, you were a PLS major, and I read your book, and, you were very smart. In your book, Honorable Business, you talked about Aristotle and the hierarchy of purpose, and, how that leads to a virtuous life and how businesses can apply that to the way they think. And I know I spent some time with Dean Kremers of the business school, and he said, I asked him a little bit, I'm trying to prepare an ESG class for my EM class. And he said, go out and read Thomas Aquinas. So he gave me a couple of books to read. And, the fundamental teachings of Aquinas are that businesses should do no harm. And that was pretty profound. And then there's been a lot of quantitative studies done that show, one study in particular that was pretty profound in my mind, was done by MIT Sloan in their business review by Kahn, Serafine, and Yoon that talked about corporate sustainable investments. And they spoke about companies that make sustainable investments. And if there's a material impact on that sustainable goal, the market will reward them for it. And if there is an immaterial impact on that sustainable goal, the market will punish them for it. So there, shows that the market is pretty efficient in the way that they're looking at the objectives of these. So I guess just kind of, moving to the presentation here, if you look at, this is a very similar slide to what Amelia had. And, clearly, when we look at companies, we look at these different factors. We look at environmental, social, and governance. And, the one thing that, when you're looking at a beverage company, for instance, the ESG factors are going to be materially different than a tech company, for instance. A beverage company, you're going to look at water stress, you're going to look at packaging, you're going to look at, a variety of factors that would be specific to a beverage company. The social issues are very, different depending on the company, depending on where they operate. And remember, there are a lot of companies all over the world that, the social norms are very different in Japan than they would be in India, for instance. Governance is very different. Governance practices are very different in a lot of different parts of the world. But if you notice here, there's a lot of different things that you need to look at. So there's a lot of science that goes into this. When you're looking at environmental footprints, there's a lot of social issues, that clearly involves the humanities. There's a lot of governance and business issues. And, Sarah Mostello at the Dean of the Arts and Letters College talks about interdisciplinarity. And, I think Notre Dame, from their perspective, should, looking at ESG, should get a lot of the colleges together to look at this holistically, because there's a lot of variables here. And when we talk to companies, we talk to them when we get pretty in the weeds on a lot of these topics, because they are pretty sophisticated. But the one thing that I have found is when you talk to companies and you talk to the CEO, if he or she cannot be fluent in a lot of these topics, chances are the analysis and the knowledge of ESG is pretty superficial within the company. So this has to go all the way up to the top. And we talk to the chairs of boards all the time about ESG issues. And if the chair of the board is not ESG fluent, a lot of what they're doing is not necessarily throughout the organization. And we can be very, very skeptical. Amelia talked a lot about the ESG opportunity. Just moving to the next page here. There's a lot of lines on this page, and I don't want to overstress the lines, but there are a lot of scenarios in terms of the growth rates in ESG assets. But it's our customers that are demanding that we have an ESG lens on our investments. I just use the example, it's anecdotal, but it's emblematic of the millennial customer. When my daughter graduated from college in 2018, I took her down to the Fidelity Investor Center, and she set up her IRA, she set up her 401k. And I said, you should invest in this fund. This person's really good. And this international fund, that person's really good. And she looks up over the sheet and she says, Daddy, where's the ESG fund? That's what the millennial investors want. They want to put their money in socially responsible investments. And when I sit down with consultants, they ask me regularly, what are you doing to make sure that your investments are ESG friendly? And the consultants are the folks that advise pension funds, they advise 401k plans, and those are my customers. So when I sit down with my shareholders, I have to turn around and talk to the shareholder or to the companies that I'm shareholders in and ask them exactly the same question. So the trajectory in terms of the assets under management for ESG, can take a variety of different paths, but the reality of it is that they are going to go up. So, what have I learned after over 30 years of visiting companies all over the world? The thing I have learned is companies that treat their employees well, that hire a diverse workforce that represents the customers that they serve, treat their customers well, minimize waste, use less raw materials, and treat the communities around them well. These companies collectively tend to withstand the test of time. They tend to be very good, durable business models. And you also find that these companies tend to have better brands, better pricing power, higher quality products, happier and more productive employees. That leads to more innovation. That leads to higher earnings quality, higher earnings growth, and better risk reward for investors and better stock returns for investors. So the power of doing good for your shareholders can result in significantly better financial returns to your shareholders as well. So that's the pitch for ESG, if you will. I guess there's some skeptics out there. If you look at the performance of ESG, and this is the performance of ESG stocks versus the world benchmark. The performance of ESG stocks have not been great since 2007. They've actually lagged the average benchmark stock. This is for the MSCI World. And as a result of that, we have the skeptics will say, well, Bill, ESG is not such a great thing. But if you take those numbers and you look at them recently, as I've done here, if you do it since 2000, and sorry to flip over to my Bloomberg screen. If you look since 2014, you see that they've basically performed in line. So the pitch here is that you don't give up any return, if you will, to own positive ESG score companies. However, if you walk around to different geographies, the interesting thing is emerging markets, the class I teach at Notre Dame, high ESG companies clobber the emerging market benchmark. And the reason being that corporate governance is very bifurcated in emerging markets, and the distribution of outcomes in emerging markets is very, very wide. So corporate governance plays a big role in emerging markets, and clearly that manifests itself in higher ESG companies. But however, I still had some skeptics saying, well, listen, how do you enhance your returns by owning ESG companies? So I did an internal study along with my team members on the ESG fund. And we took a basket of stocks that are rated by Fidelity analysts all over the world. And we have hundreds of analysts all over the world. We have analysts here in Europe, we have analysts in Japan, analysts in Hong Kong. And we took these stocks that were non-US developed market stocks. There are hundreds of stocks, okay? And we took them, the study went back to 2014, and we took the buy-rated stocks in this universe, and we saw how they did versus the benchmark. They outperformed the benchmark. So we had a good fundamental outcome by buying stocks that we liked, and we outperformed the benchmark. However, if you did a second layer of analysis and you took the top quintile, according to MSCI, of the ESG names in those buy-rated stocks, they outperform the buy-rated stocks. So if you take a basket of fundamentally attractive companies, you own those, you'll outperform the benchmark. However, if you do a second layer, according to this analysis, and this is backward tested, you do a second layer of analysis and own the ESG leaders within that basket of buy-rated stocks, those stocks did better than the fundamentally attractive companies. They were the best of the best. So what does that tell you? That tells you over this period of time, the market rewarded companies that had high ESG credentials. And for a company that lives on generating alpha for our shareholders, in other words, picking stocks, this is a very good way for us to enhance our stock picking ability by incorporating an ESG lens. And what did we find with these? We found this worked across a variety of different sectors and investment styles. So if you were a growth investor, you could do well versus the growth benchmark by incorporating this. If you were a value investor, the same way. But the interesting thing is that these high ESG companies had the highest earnings growth of all the companies that we tested. So what does that tell you? That tells you incorporating ESG into your analysis can get you the companies that are delivering the best returns for their shareholders. A lot of people will give me pushback and say this is a very defensive strategy, Bill, but you're kind of picking stocks by eliminating all the bad stuff. However, if you're a growth investor, ESG is loaded with growth stocks. You look at the opportunity in clean energy, wind and solar, lots of opportunity in wind and solar. The United States and Europe are going to double. Well, Europe's going to double. The United States is going to quadruple the amount of green energy that we have to provide electricity to all of us between now and 2030. Electric vehicles, the internal combustion engine will die out over time. Matter of fact, Boris Johnson here in the UK is going to outlaw the sale of new internal combustion engines by 2030. And that's the case throughout a lot of Europe. So we're playing it by owning battery companies, fuel cells, et cetera. And there's a variety of other ways to play this pretty exciting opportunity. Another area that's really promising is bioplastics. They biodegrade a lot faster than traditional plastics that are generated with petroleum. So the technology in this industry is changing very, very fast and really exciting for investors. So ESG is an offensive way to find really good financial returns by owning companies that are really embracing this ESG. Things that we typically exclude in an ESG portfolio, these are pretty obvious: tobacco, gambling. The one thing that is really becoming a big theme is being able to trace your sourcing. Child labor is a big issue. Slave labor is a big issue in a lot of markets, and being able to trace where you're getting your raw materials from is a big theme. So if you look at an average ESG portfolio, it should have better environmental scores, higher social scores, better diversity and inclusion scores. It should have obviously much better corporate governance, higher percent of women on the board of directors. And what we do is we take this portfolio and then we run it through metrics provided by MSCI in order to say, so we can go to our shareholders and say they scores better on all of these brackets. So, the world of ESG is exciting. It's providing lots of opportunities for investors. And the good thing is that as we move into this stakeholder economy, if you will, as Amelia had mentioned, it's still moving into an area that is very good for business, good opportunities for investors, and investors can really win as this happens. So that's kind of what we're thinking about in the investment world. And I guess we're going to throw it open to questions.
Thank you very much, Bill. That was terrific. That was a great discussion. So we do have some questions that have come in, and I would remind the audience that if you have any questions you would like to pose, please use the Q&A function. Perhaps I'll start with a quick question to each of you. I'm happy to hear both of your thoughts about these questions, but the first one is more, I guess, to you, Amelia. You mentioned the transition from CSR to ESG, and you were talking about this sort of development. The CSR literature, I guess one could be forgiven for thinking that the presumption of a lot of that literature was pretty negative regarding business activity, as if, business activity is pretty morally suspect. That's why it needs to figure out ways to atone for the various sins that business engages in. In the transition you see from CSR to ESG, do you see that as a shift that people are thinking, no, businesses can be forces for good? Or do you still see some of this? Well, we need to be suspicious of business, and this is a way to maybe try to minimize the damage that they might otherwise do. So that's my question for you, Amelia. My question for Bill, and I'll give you a chance to respond first, Amelia. But my question for Bill, thanks for that fantastic presentation. So here's my somewhat skeptical question. If ESG is so good for businesses and the market is demanding it and rewarding ESG, why isn't everybody already doing it? Why do we need to convince people to do it? Isn't this something that it sounds like, and I'll be particularly provocative here, Bill, since you and I know each other, I feel like I can do that. Wouldn't Milton Friedman say, yeah, that's exactly my argument. I didn't say that that you should never engage in activities like ESG. I said it should always ultimately be with an eye towards profit. And if the way to create profit and shareholder value in this current environment is by engaging in ESG, yeah, that's part of that's just, how we respond to the market. So is there any particular moral content there that separates that from profit, or is it still ultimately just about profit? Amelia and then Bill, but go ahead, Amelia.
Yeah, thank you. That's such a crucial distinction. And I agree with you completely. I think CSR came from a really moral underpinning of believing that business is, generally oriented, and indeed was. That was the normative orientation towards shareholder value and externalizing its costs onto society and the planet. And ESG is, really rooted in a belief that no, business can be a force for good. Like Salesforce is sort of a paradigmatic example of a strong ESG company. And, they believe that business is the greatest platform for change. But I do want to point out that there is a debate within the CSR and the ESG movement on this, where a lot of advocates of CSR believe that the market sort of usurped ESG and made it oriented towards shareholder value, whereas CSR was really oriented towards addressing the externalities of business. Irrespective of whether that ultimately led to short-term or long-term value.
Thank you, Amelia. Bill, are you really just channeling Milton Friedman?
No, I think I do think that ESG has made businesses much more aware of the potential negative effects of what they've done in the past. And I think what it's done is it has created, in a sense, it's created almost a framework under which bad actors are excessively punished. So if you're a bad actor, you're punished much more because there's just a more general awareness over the last, don't necessarily say the ESG has been around for 10 years, but over the last couple of decades, there is an increasingly bigger awareness of the social consequences of business. There's a bigger awareness of the consequences of what businesses can and can't do, I think really since the global financial crisis. And bad actors do get punished. If you have an issue with a copper mine in the DRC, and it comes out that you have allegations of bribery, your stock gets hit really hard. And chances are you are going to have to explain a lot. And chances are your management team will probably serve time in prison. If not time in prison, will be in a lot of trouble for a very long period of time. And so there's a real sense that, particularly given the free flow of information with the internet, that companies that are doing the wrong things are being punished egregiously by shareholders, and the ones that are doing well are being rewarded by shareholders. So, it's Adam Smith telling, the good companies to keep doing what they're doing and the bad companies to clean themselves up.
That's great. Thank you very much. Thank you, both of you. So we do have some questions that have come in from the audience. So I'll mention this one, I guess, which is for both of you. So Joel has a question about the pandemic and thinking about workers now returning to work. And the question relates to wage gaps on the one hand, but also scheduling and working conditions, and maybe even remote working. And the question is, do either of you see in the ESG framework space for allowing greater employee options, mobility, working conditions? Is this something you see coming in the future, or is this just one-off because of the pandemic, or what's your interpretation of that?
Yeah, I can jump in. So there has been a greater focus, and I think Bill has seen this as well, on the S of ESG, social issues in general, and workers are at the center of that. It's materializing in all sorts of different ways. It's materializing in an increased focus on mental health for employees. And this is, when I say this, this is asset managers specifically asking companies what they are doing to manage the mental health of their employees. It's certainly working conditions, how companies are transitioning from, into a new economy where remote work will be more prevalent. So I think there's very much of a focus on that. And I think the question also asked whether shareholders and regulators will continue the focus on that. And that's absolutely true. Anytime a company makes a commitment, broad commitment to anything, to diversity, inclusion, to employee well-being, you can bet that there are shareholder plaintiffs who will seize on that, or regulators, and say there is an inconsistency between that company's practices and what they're actually doing on the ground.
Thank you. Bill, did you have something you wanted to add? Go ahead.
Yeah, Jim, I agree with Amelia. We're talking to companies about change in work practices. A lot of companies were able to get to remote working pretty easily, and we were impressed with the way companies were able to do that. The reality of it is that, I hate to use the cliche, a happy worker is a productive worker, but if you go and there's a book that, I thought was pretty interesting that I recommend people read. It's called Growing the Pie by Edmonds. And he he did a study about Glassdoor surveys, and the better the Glassdoor survey results, the better, company profitability and corporate value was. So it's quite clear that the studies do show that, the happier the employees are in general, the better the outcome for shareholders.
Thank you. So our next question is something of offers something of a gentle criticism, which is that perhaps the discussion has been at a little bit too high of a level. So we've had a couple questioners say, well, can you be more specific? What's the percentage of companies that are actually integrating ESG, and would you like to name a few? So thinking about students who are going to be graduating and going into the working world, are you willing to mention some companies we should look for? Are you willing to mention some companies we should avoid? Whoever wants to take that on, go ahead.
Well, I am, unfortunately, my compliance department really prohibits what I can talk about companies because it's deemed as perhaps in recommending an investment in a company. What I would do is you can quickly find out. You can go to the sustainability report from on a company. You can go right to their investor relations website. And that's very, very easy to do. And you can go through the detail and how detailed is it? And are they fully embracing it? And the first thing I do to see if a company really believes in it, I go to how management is compensated. And is management compensated? I go to the first thing I do, particularly with a mining company or something that where there could be some problems, I go right to the management compensation page to see on a publicly traded company to see, is management compensated to hit carbon emissions targets? Are they compensated to hit water stress targets if they're a beverage company? Are they compensated to hit diversity and inclusion targets, et cetera? You know, that to me is a big issue. I have a Japanese holding where the management team is compensated in a certain way to get more females in their management because it is very, very low. Females as a percentage of the management team in Japan is extremely low, and they need to do a lot better there. And so now management is compensated to hit those targets. That's the kind of things I look for. So I think as people start to look at different companies, go to their public filings and see, are they, not only are they talking about it, but are they forcing, is management, you know, is it part of their KPIs in order to measure their own success?
Yeah,
Go ahead,
and
Amelia.
I can briefly jump in too. So the question, and I saw it in the chat, and thank you for asking it. Really, there are a few implications. So one, the question is, you know, is sustainability reporting becoming more mainstream? And the answer is yes, absolutely. Over 90% of companies have some sort of sustainability report. Now, the problem is because we don't have mandatory reporting, those reports are very hard for investors to compare apples to apples, right? So there's a lot of idiosyncrasies between one company's sustainability report and another. But we've seen a lot of progress and a lot of coalescing in the sustainability reporting landscape. So I had chatted out some resources. We're going to have probably mandatory reporting in some form from the SEC. That's what the signaling has been. And Larry Fink this year said that companies that BlackRock invests in should use the Sustainability Accounting Standards Board standards and the TCFD framework. So we can expect to see much more reporting using the same framework. But you know, it took a long time for financial reporting to become mature, and that's the journey that sustainability reporting is on today.
Thank you. So a related question, April asks about advice for students. I think this is fairly close to what we were just talking about, but put it slightly differently. If you're a student who's just graduating and joining a company, oftentimes you don't have a lot of leverage with what the company is doing. You might not have a lot of options. If you're committed to something like ESG, what exactly are you supposed to do and what kind of leverage might you have? Maybe that question is for Bill or Amelia. Yes, go ahead, please.
Yeah, I have actually been incredibly impressed with how much leverage my students have had, even as students and then as graduates. Look, companies are very sensitive today to their reputational risk. And I'm certainly not suggesting that you go into a company and launch a social media campaign against that company. But all I'm saying is that there have been many, many instances of that, an increasing number. And so that is leverage. And companies do care very much what their employees and what their talent believe. What I would do is I would find the internal champion for the company, internal ESG champion, whether that's the head of sustainability, whether that's a general counsel. It's different at each company. And I would reach out and ask to meet with that champion. You might be surprised at their enthusiasm for wanting to meet with somebody who is similarly committed to what they're trying to champion within the company.
Thank you. Bill, did you
I
have
thought that was a great answer. And the only thing I would add is don't underestimate, there's a lot of employee resource groups, ERGs, in a lot of corporations now, and you'll be amazed how many advocacy groups there are. And just the willingness to create advocacy groups is pretty amazing compared to a couple of decades ago.
Thank you. So we have a question that is for Bill in particular. So I'm just going to read this question. Some have argued that ESG is the lowest common denominator, something like do no harm, in terms of environmental social impact versus impact investing, which has a range of activities from finance first to impact first investing. So since you seem to facilitate an impact investing fund, is this simply semantics that we're talking about?
Yeah, I mean, that's, I wouldn't say it's semantics. It's conducting your business in the most environmentally friendly, the best socially friendly, and with the highest corporate governance. So, but you can have positive impact on what you do. You know, I have visited European and American companies that have set up factories in Africa, for instance, and the impact they have on the communities that they invest in is pretty profound because they bring in modern labor practices, they bring in technology, you know, they bring in a variety of things that wouldn't have happened. So they really are impact investors. You know, when you put if you put a food plant in a small African community that's going to serve quite a long big part of the country, you know, the employment practices they bring in, the standards they bring in for hygiene, a lot of times they educate the people in the town where they're operating in. So, you know, they wind up having a pretty positive impact on the community in which they operate in. So, you know, impact ESG is, and they're incorporating a lot of their ESG credentials when they come in. So, you know, there is a lot of benefits from ESG that perhaps may not necessarily be seen, you know, as you go through and just try to say, well, this is our environmental footprint, we're trying to reduce it, this is what we're doing, you know, on our social and all of that. But they're, you know, multinationals all over the world, as they start to implement ESG practices and roll them out to other parts of the world, have a profound impact on the communities where they're operating in.
Thank you. So I have a question from Dan, which I think is for both of you. And that is, so we've been talking about impact investing, specifically thinking about where to invest our funds. Do you see ESG as applying to other areas of business? In particular, the one that Dan is interested in is commercial real estate. So are there other areas of business that are also thinking about ESG, or is ESG coming up in other areas of business, or is it mainly just in investing?
Oh, no. So it is pervasive throughout the business community, and increasingly, I mean, it was stronger in public companies, but increasingly private companies are embracing ESG as well. And the point that he made is really important, which is incentives, right? And Bill touched upon this. If the incentives for commercial real estate are aligned solely with financial metrics, then you're going to have a mismatch between the behavior that is rewarded and actually rewarded and the ESG metrics. And that's why Bill looks at the incentive packages. So I think that the companies that are, in all industries that are doing this well are aligning incentives with the ESG priorities.
Yeah, and commercial real estate is a good example where you can have green buildings that have lower carbon footprints. And a lot of tenants, particularly big corporations, are demanding that their landlords put in, greener facilities for them. So again, it's the customer demanding it, and the market forces are demanding it. I talk a lot because I look at some building materials companies, and my daughter's a structural engineer and she's really fascinated with the environment. And we talk a lot about, she had to take a few classes in concrete, and there's different degrees of concrete that go into the construction of a building that have, various lower carbon footprints if you do things with the concrete when you manufacture it, and when you recycle the concrete when you take the building down. So there's a whole carbon cycle with it, with the building, and taking that into account in commercial real estate. So you can incorporate ESG in something, like commercial real estate, because your customers are going to ask you to do that.
So maybe we have a few minutes left. We have several questions, but maybe I'll try to put a couple of them together. And ask maybe a critical question, and that is, are there some limits to this that we should, or some thresholds we should be worried about? And in particular, one thing that we've seen rising recently is CEO activism. So we've seen a lot of companies that are taking what in a previous era, or maybe what some critics might think are their personal politics, political agendas, or moral agendas, and putting them into the public sphere as representatives of the company. There are lots of examples of this recently, and even more recently, I think it was Basecamp. There are some companies that have decided publicly not to do that. Do you see the potential political activism of companies as being part of ESG? Is it a positive development? Is it a worrisome development?
Yeah, it absolutely is a part of ESG, and it's that in that matrix on the slide that I have, it's a version of an expectation of society for companies to address systemic risks that were traditionally managed by the government. And so whether it's a positive development or negative development, I think it's both. So there are a lot of risks, and there's a lot that we should be worried about. You know, CEOs are not democratically elected officials. So the accountability question is certainly worrisome. But look, if employees, consumers, investors are expecting this, and your social license to operate as a company depends on taking a stand on issues such as voting or racial justice or environmental justice, then a company, there are no sidelines for that company. Either they have to do what Basecamp did and say no and face the repercussions, or they wade in to this new world, and there are risks on all sides there.
Yeah, I can't add much to that because it was a great answer. It's a very, you know, the CEOs and, you know, clearly at the direction of their board need to weigh a whole bunch of different competing interests sometimes. And, you know, but the reality of it is that if their employees are demanding them to take a stand and their shareholders are demanding them to take a stand, you know, there may need to be something, they need to feel like they need to comment. However, I do share Amelia's views that, you know, this is a totally new area, and it's something that I'm going to have to watch to see how it develops. But the reality of it is that, you know, this seems to be much more prevalent now than it ever had been before. So it's an area as an investor we have to just we're just sitting and kind of watching and analyzing before I have a really strong opinion on it either way, because we're just so new into it. We really are.
Actually the subject of my current paper, where I'm interviewing companies and asking them, what's the nexus between your business and engaging on voter suppression? And it's really fascinating.
Well, when that paper comes out, Amelia, please let us know. We'll put that on the Deloitte Center website. So here's since we teach at a Catholic university, we inevitably get questions about Catholic social thought. And John asks one, which really is, from a Catholic point of view, should we unqualifiedly support ESG? So, for example, there are some aspects of Catholic social thought that talk about the inviolable dignity of the human person, transcendent value of natural moral norms. As a Catholic, are some aspects of ESG going to be in conflict with Catholic teaching? And if they are, should a Catholic think, well, I shouldn't endorse fully ESG. Should I go in a different direction? I'm not sure whether either one of you has a position on that or would like to add something to that.
Yeah, it was a great question. I saw John ask it, and it's a question that underpins the debate as to whether we should make a business case for these things or a moral case. So there are some things, such as, you know, some would argue diversity, human rights, certainly, where the ESG movement makes a business case for those things. But if those are fundamental, intrinsic rights that all human beings should have, irrespective of long-term or short-term shareholder value, then embracing them under an ESG umbrella does become problematic from a moral perspective.
Bill, do you have something you'd like to add to that?
No, I do think that their ESG embraces things that I think most people would agree to. It's inevitable there will be conflicts between, different people with different cultural backgrounds. But the reality of it is that 99% of the issues I think most people agree with. Having less water stress, having less carbon emissions. I think 99% of the things that we're talking about day to day, most people, to Amelia's point, would agree with. And it's kind of, it's in the very fringes that there will be issues that are inevitably people will beg to differ.
That's well said. And I think I would say that an additional thing that probably almost all of us agree on is that human beings have dignity. They should be respected as such. And it's an important moral obligation for those of us who either work in business or invest in business or work with business, that we want to find ways for business to respect and uphold that human dignity. So ladies and gentlemen of the audience, thank you for joining us. This talk and discussion will be available on the Deloitte Center website. It has been recorded. We will put it on the website so you can refer to it after that. And I would like to extend my sincere thanks for a fantastic discussion to Professor Amelia Miazad and also Bill Kennedy. Thank you very much for joining us, and it's been a pleasure.